he's been saying in recent reporting that he'd like to see the federal funds rate at 1% within a year. And actually, there's a very objective way of knowing that the market does not agree with him on that point, and that's by looking at the yield on the 2 year. So here's how we think about longer term bond yields. If you wanted to invest over some period of time, you can just buy a series of short term Treasury bills, right? Say 3 months, and then you can roll it over into another one and another one. And you can do that over whatever period you want to invest over. So, in that sense, longer term bond yields reflect an average of expected short term bond yields. So, when you look at the 2 year, that's essentially the market's guess of where short term bond yields will be in the near term. And right now, it's about 3.5. The 2 years has been about 3.5%. I haven't checked it this morning, but so it's effectively flat with where the federal funds rate is today. What the market is telling you with that is that the federal funds rate is not expected to move anytime soon. And this is important given that the rate of inflation, whether it's the consumer price index or the personal consumption expenditure index that the Fed follows, that's been nearing 3%. There's really nothing on the inflation side that would justify aggressive cuts. So unless we have a big economic slowdown, I don't really see that happening, or you see just inflation come falling down. For a lot of reasons, I don't see that happening either. So point being, I would not expect a sharp reduction in short-term bond yields unless we see a major politicization of the Fed.